Hi everyone, in this video we'll be starting with the chapter number 7, Momentum and Oscillators of CMT level 2. Before watching this video, make sure that you check the previous chapters as well. The link is in the description below. In this chapter, we'll actually just look at the kind of oscillators and momentum based indicators which we have. For example, stochastic, RSI. So these are the most common indicators which we use. So we'll get to know what exactly are these indicators and why do we use them and how do we use them in our trading. Okay. So first of all, you need to understand that until now we've been discussing about price levels. We were talking about a particular price point or a particular price level. Time was never something which came into the whatever we discussed. We really didn't discuss about the time. Now in this chapter, we'll be discussing about the rate of change of the price. Whenever we talk about rate of change, we are always taking into account a particular time period. For example, how much did the price change today as compared to yesterday? So that is what is known as momentum. We'll get into it in detail in this chapter. So until now we were discussing about price levels. In this chapter we'll discuss about the price changes rather than the price levels. Momentum basically talks about the speed of the price. At what speed is the price moving? What kind of acceleration is the price showing? So when we talk about acceleration, now that is something which if there's a car and if I tell you that the car is moving at a speed of 60 kilometers, what does that mean? That means that the car is moving at a speed of 60 kilometers per hour, right? So that per hour, when you include time into the particular thing that we are discussing, then that is what is known as momentum. So if I say that the price is moving 100 points per day, the index is moving 100 points per day. So per day, the timing has come into account, which is why we call it as momentum. So analysts use momentum with slope. We'll discuss slope in detail. Slope is the angle of inclination. We will see that. So in maths, we have something known as the first difference. The first difference is basically the difference of price between today's price and the previous day's price. So if today's price is P1 and yesterday's price is P0, then we are going to see what the difference is, and that is what is known as the first difference. And Newton's law states that prices tend to remain in motion and more or less in the same direction. Indicators of change, such as momentum and oscillators, are used as leading indicators of price direction. So, the momentum and oscillators, which we are going to see, these are basically leading indicators and not lagging indicators. When we were talking about moving averages in the previous chapter, we discussed that they are lagging indicators, and lagging indicators basically give you a late response. The indicator shows signs after the price has moved. Whereas when we talk about momentum indicators or oscillators, we're basically using leading indicators. So they give us a signal even before the price movement happens. So in that case, we can use these indicators to take an early entry. That is the advantage between using a moving average and using momentum indicators. They can basically identify when the current trend is no longer maintaining the same level of strength. Even if there's an uptrend going on, we need to know whether it's going to sustain or is it going to reverse. So all that we can identify when we start to study about the momentum. Okay, so you can look at this particular diagram which is given. This is the geometric representation of momentum. There's nothing to be worried about. There are two angles, A and A dash. You can see that. So n days is the number of days, be it 1 day, 10 day, 4 days. So we are basically identifying the price at a particular number of days or a particular period of time. So initially the price was 0. Then the price is at P1. In that case, the momentum is going to be price upon the time or the number of days. Then slowly the price became P dash. In that case, it's going to be P dash upon N. This is how you calculate the momentum. And you can see when the price was lower, the angle was less, but when the price became higher, then the angle also increased. Simple stuff. Okay. So momentum indicators are also used often in counter trend or mean reversion strategy. Counter trend is basically when there's an uptrend going on, if you want to take shorts. Then if you want to take counter trend or mean reversion strategies, mean reversion is nothing but counter trend strategies. In that situation, you can use momentum indicators. Okay. So a brief comment on terminology is necessary to understand how various techniques are grouped together. The use of a single price, such as Microsoft at 25.5 or gold at $1,400, has no direction or movement implied, because we just know that the price is this much. We don't know, like, we don't really know how much time did it take to reach there or how much of a move it showed. We only know this particular level or point of price. When you are going to use momentum, you are also going to see the timing and you are going to get the movement strength, which is also accounted. Okay. To know the speed, it is not enough to say that S&P rose 3 points. You must specify that how much time did S&P index take to raise 3 points. The S&P rose 3 points in 1 hour. Now that makes sense, right? When I just said that S&P rose 3 points, that really didn't make sense. Okay, this is the car example which I had already discussed. Okay. If the daily momentum of Nasdaq 100 is plus 10, then it is rising at a rate of 10 points every day. If I say that the momentum, everyday momentum is this much, that means that I'm expecting that the particular index will give this much of momentum in one particular day. Having made a point of saying that momentum is change over time, which it is, the industry uses momentum to mean price change with the time implied, where speed is always the price change divided by the time interval. That is what we saw in the graph, right? The term rate of change will also be used to describe acceleration and increase or decrease in the speed. When the rate of change is zero, then we are talking about speed and momentum. Okay. You will also see that acceleration is more sensitive than speed. Okay. Momentum. Momentum is the difference between two prices taken over a fixed interval. So we need to have one fixed interval and we need to have two prices to calculate the change. Now, how am I going to find that? If I want to, let's say, find the 5-day momentum, how will I find it? Today's price is PT. 5 days ago's price is PT minus 5. So momentum is today's price minus the price which was there 5 days ago. That is momentum. Very simple. So in this case, we took PT minus 5 because the N is given as 5, which means 5-day momentum. If I said that I want to find the 100-day momentum, it would be today's price minus the price 100 days ago. Very simple. Just replace the N with the number of days. Today's price minus the price of the nth day before. The momentum value MT increases as the change in price increases over the same 5-day period. Figure 7.1, okay, 7.1 figure we had anyway discussed. So they are again explaining the same thing. We also discussed the angles. Okay, one thing you need to be very clear about is that momentum is not volatility. Gold can move from 1200 to 1250 in 2 days, then it can again come back to 1200 over the next 3 days. In that case, the momentum would be zero. Why? Because the price which it was 3 days ago was 1200. Today again it's at 1200. So there is no change with regards to the time. So the momentum is zero. But the volatility is high because at one point in this given period, the price did reach to 1250. Figure 7.2 shows the pattern of momentum. Let's see this. So this is a graph which they have given, and the graph which is above is the price and this is the momentum. You can pause this video and see how they are related. When the momentum was going down, the price was going up. Then the momentum slowed down. The price also slowed down. The momentum started picking up here and the price also started picking up here. You can also see that momentum started going up from here but price started going up from here. So you can see how momentum gave you an early signal to enter into the trade. So that is how you use momentum in your trades. Okay. Now let's see what are the characteristics of momentum. Momentum is again a way of smoothing the price movement, and we want to basically reduce the noise which is there in the price action in order to make clearer decisions. Although momentum values are not as smooth as moving average, larger momentum periods reduce the extremes seen in the price chart. So, no matter which indicator you're using or no matter which strategy you're using, everything works better on a higher time frame for obvious reasons. Let's look at the chart which they've given here. They've given you an example of a daily chart of AOL. It's probably a stock. And they've plotted two moving averages and the momentum indicators. Now try to see the difference between the momentum indicators and the moving averages. Okay. So let's see the explanation which is given about this particular figure. We have a 20-day and a 40-day momentum along the bottom with the moving averages. So the 40-day momentum is smoother and it peaks at about the same place as the price. Now why do you think that is so? Because 40-day momentum is going to be giving you better signals as compared to 20, because 20 is a very small time frame and it is a faster momentum. So it can give you earlier signals, but it can also give you a lot of whipsaws or a lot of fake signals. Whereas the 40 moving average and the 40 momentum indicator will give you more legitimate signals. So looking at this, the dark one is 40, the dark one is 40. So you can look at what they have been explaining. So as the price was going up, the 40 was going up as well. And you can see that the 40 started going down and the price went down as well. You can see that the lighter momentum was giving you earlier signal. You can look at this. It's giving you earlier signal, which can also be fake. When the price was going down, the lighter one was going up. So the 20 momentum period can give you a lot of fake signals. That is what is being discussed. Okay. Momentum can be used as a trend indicator by selling when the momentum value crosses downward through the horizontal line at 0 and buying when it crosses above the 0 line. So the middle line which you can see over here, that is 0. If the price is crossing above it, somewhere over here, it was crossing above. So here if you would have bought, you can enjoy this rally. Similarly, just a second. Yeah. Similarly, when the momentum crossed below the 0, then if you would have shorted over here, you would have enjoyed this fall. So that is what they're explaining, that the middle line is the 0 line, and if the price crosses it above, you buy. If the price crosses it below, you sell. Okay. So now this is one kind of a momentum indicator. The next type of momentum indicator would have bands above and below instead of the 0 line. So it will have bands like this and this. In that case, whenever the price goes up from here, you buy. Whenever it goes down from here, you sell. Let's come to that. That's overbought and oversold. Okay. Momentum as a percentage. It is always convenient to express all markets in the same notation, be it forex, be it stocks, be it crypto, options, or commodities. We need to be able to express all of the markets in the same particular notation. So when you have the same notation, what happens is that you are able to compare the both of the markets more easily and in a systematic and a uniform manner. So momentum can be expressed as a percentage where 1 day momentum is equivalent to 1 day return. So what does that mean? If you're talking about 1 day momentum, it would be today's price minus the price 1 day before divided by the 1 day before price. This is 1 day before, 1 day before. T is today, T minus 1 is today minus 1 day, which is yesterday. So this is the formula. Momentum is most often calculated for over 1 day. We don't say what was the return in 1 day. We usually say what was the return over a period of 6 months, what was the return over a period of 1 week. So usually momentum is calculated for a period of more than 1 day. But even then, the formula remains the same. Momentum with the number of days is PT upon PT minus N minus 1. Today's price divided by yesterday or that day's price. Then you are going to subtract 1. That's going to give you the momentum. Today's price divided by that day's price minus 1. Very simple. Just try to learn it right now. Today's price divided by that day's price minus 1 is going to give you the momentum. It's basically a rate of change. So you know why the denominator, what the denominator is going to be. The denominator is going to be the price of that particular day. Using percentages does not work for futures market. Again, you know that futures are basically calculated with a lot of backward price. So in that case, percentages cannot be calculated. The term momentum is very flexible. It is common for it to refer to the difference between today's price and a corresponding moving average value in a manner similar to beta, which indicates the relative strength of a stock as compared to the index. You know what beta is, right? Beta is basically the comparison between the stock and its index. So, momentum, when the momentum becomes large, then the prices are moving away from the moving average. When there's high momentum, then the prices are going to move away from the moving average. As the momentum moves towards zero, then in that case, the price is coming towards back to the moving average. Figure 7.4, let's quickly see that. Okay. Momentum is also called as relative strength. We can also discuss the RSI indicator. The difference between two prices or a price and a moving average. Okay. So if you look at this particular chart, I know it's not clear, but this is the chart of Intel and this is the price with the moving average, and here we have momentum. Now let's read what's written. Yeah. 20-day moving average. The center panel shows the standard 20-period momentum. The difference between the prices are 20 days apart. If we are talking about a 20-period momentum, then we're clearly talking about the 20-period difference. And the bottom panel is the difference between the price and the 20-day moving average. And we have a range for the same. Okay. All right. The momentum value is a smoothing of price changes and can serve the same purpose as a standard moving average. Many applications use momentum as a substitute for a price trend. Why do we use momentum instead of a moving average? Because momentum has less noise as compared to the price. Because the immediate fluctuations which are there, they're often ignored when you're using momentum indicators, and in that case, you can obviously always correlate with the price and you'll be able to make decisions easier. This is very similar to faster and slower moving averages. The use momentum To use momentum as a trend indicator, choose any calculation period. A buy signal occurs whenever the value of the momentum turns from negative to positive, and a sell signal is when the opposite occurs. We have anyway discussed this. This is basically oversold and overbought. We'll see that. Whenever the momentum is zero, that means that it is neutral and it is sideways and there hasn't been any change in the price. Okay. One more thing where we use momentum a lot is when you want to have a particular proper timing when to enter the market, because the most important thing is what time do you enter the market and when do you leave the market, right? So that is extremely important. When do I enter the market and when do I leave the market? So for that purpose also momentum indicators are really used in order to find good entry points. So in that case, what you do is you basically take you see, whenever you're doing technical analysis, you need to do multiple time frame analysis. So you need to look at the higher time frame analysis, and in that case, what happens is that you are going to see the higher time frame, and you are going to take an entry on a shorter time frame. So you can use the momentum indicator on a shorter time frame to take the entry. Again, look at this. The price created a bottom and the momentum also went from negative to positive. That is a buy signal. This is the overbought and oversold. If I show it to you on trading view, let's see that. I don't want to mess with gold right now. Let's see something else. Euro. Yeah, we can see this because I even took a trade today. I didn't use the RSI, but you could have. If you look at this chart, you can see that in this particular area, the price crossed down. So that gave you a sell signal. And imagine what happened with the price. If you would have taken the sell signal, you could have captured good 10 pips by just following the RSI. Anyway, just don't hop onto the charts and trade just based on this. That's not how stuff works. But it's just an example and as how you can use it as a confluence. Here you can see when the price created double bottom, and at the same time the RSI also crossed from below to above. So you could have taken a buy over here. So you could have captured a good 25 pips. That is RSI for you. Identifying and fading price extremes. An equally popular and more interesting use of momentum focuses on the analysis of relative tops and bottoms. All momentum values are bounded. So you know that momentum values are bounded by above and below. So what do I mean by bounded? It means that it has an upper value and a lower value. Here you can see the upper value 80 and lower value 16, whatever you can see, right? So it's basically bounded both ways. That is what they're trying to explain. The conditions at the points of high positive and negative momentum is called overbought and oversold respectively. So when a market is overbought, it means that it has been bought extensively and now it cannot be bought anymore. Oversold means that it has been sold way too much and it cannot be sold anymore. So that's what we have discussed here. Here when the one sec, yeah. Here when the price was above this and it crossed down, that means that the price has been overbought and it needs to sell, which is why the selling occurred. Here you can see that the price crossed this, which means that it has been oversold. So from here you can buy and the price would go up. That is how you basically trade, and that is how you basically use a momentum indicator. Okay. Hmm. Yeah, faster momentum calculations will tend to fluctuate above and below the zero line based on small price changes. Now, that's what I was saying. Even if you take a moving average of a smaller time period, then the same thing happens. So, the same thing happens even when you take a smaller time frame momentum indicator as well. It's the same thing again. The 20-day momentum in the center panel stays above zero for most period from September 2010 to February 2011. Look at this. September to February. You can see that the moving average, which is 20, okay, I need to see this. Yeah. So this one is a 20-day momentum period and this one is a 3-day momentum period. Now, if you look at it, you can see from here to here, the momentum was always above zero when you're looking at the higher time frame. But when you're using a smaller time frame, then it was fluctuating above and below zero. So that is why I'm saying if you could have just seen the 20 period momentum, if you could have just seen that the price was above zero, then see you could have captured this entire rally. But if you would have seen the smaller time frame, then you could have been scared and you might have sold over here. So you need to always trust and believe in the higher time frame indicators, and you need to only use the smaller time frames for getting an optimum entry. Okay. A system can take advantage of the momentum extremes by fading the price movement, selling rallies, and buying declines. This is done by drawing two horizontal lines on the momentum chart, above and below the zero line, in such way that the tops and bottoms of the major moves are isolated. So these lines are basically the lines which we use even in RSI, and you can see you can take decisions based on the way the lines have been penetrated. So once the line is penetrated, price reverse. That's how we discuss. That's how the RSI works, based on a percentage of the maximum possible momentum value. So based on the percentages, using two standard deviations would position the line so that only 5% of all the momentum values penetrate above and below. So you need to understand that whenever we are drawing the bands above and below the momentum indicators, we are usually considering standard deviation. Standard deviation is always considered when you're drawing these bands, because that is something which will give you a very optimum value, such that only 5% of the price can go above and below the bands. The rest of the price movement is going to be in between our indicator. Only the 5% price will be above and below the bands. When positioning these bands, there is always a trade off between finding more trading opportunities and entering the market too soon. Once these lines have been drawn, the entry options will be the following. So, you know the entry options, you know that overbought, oversold, when do you buy, when do you sell. We've discussed that in level 1 as well. So, the first thing is aggressive. Entering a long position when the momentum value penetrates the lower bound, entering a new short position when the value penetrates the upper bound. So that is aggressive. So we are not waiting for the band to go up and cross it down. We are just waiting for it to cross it up. We are not waiting for it to cross it down. The moment it crosses up, you are selling. That is very aggressive. If you could have waited for it to cross up and then cross down, then you are being conservative. Minor confirmation is when you enter a new short position on the first day the momentum value turns down after penetrating the upper bound. So here also we are taking a confirmation which is better than the aggressive entry, but you are not waiting for the downwards break as well. All you're doing is you're waiting for the daily candle to close, and you're going to just see that today did the momentum pierce it, and when the day ends, the next day you sell. But still you're not waiting for that one particular confirmation, which is when it goes down. Major confirmation, entering a new position when the momentum value penetrates the upper bound, moving lower. So this is what I discussed, that not you're not going to enter the moment the band is pierced like this. You're going to enter when it again pierces it down. So that is a major confirmation. Timing. Enter a new short position after the momentum value has remained above the upper days for n days. Now that is again according to your discretion, according to your knowledge, that if it stayed above for 3 days, which means that it is strong, or if it stayed for 1 month, then maybe it is strong. Whatever your way of trading is, that's according to your particular time frame. So this is another way to use. So not just this, not just to enter the trades, you can also use these momentum indicators on deciding when you have to close your existing trades. If your trade is going on, you want to know when you want to exit from it, when do you have to book your profits. Even in that situation, you can use the momentum indicators. So, what is the most demanding case? Closing out long positions or covering short positions when the momentum value satisfies the entry condition for a reverse position. If you think that, if you're looking at the momentum indicator and you think let's say you're in a long position, and you can see that the momentum indicator is at an overbought place, that means selling pressure is coming. So is that a good situation for you to stay in the trade when you know that the momentum indicator is showing overbought? No, which means that's a sign for you to book your partials or book your entire thing. Then we have what is known as the moderately demanding condition. Cover a short position when the momentum penetrates the zero line minus 1 standard deviation. Again, let's read it again. Cover a short position when the momentum penetrates the zero line minus 1 standard deviation. So, what does that mean? If you're having a short position and you'd want to know when you have to book, then you can draw another horizontal line, which is basically going to be the zero line minus 1 standard deviation. That is a very optimum level for you to cut your trades. Again, what is it? Zero line minus the one standard deviation. That is a good area for you to cut your position. Next is basic exit, covering a short position when the momentum value becomes zero. You know that if it's zero, then you know that there is no momentum left. So there is no point for you to stay in a sideways market. Allowing an extended move. Cover a short position if the momentum crosses the zero line, moving up after penetrating that line, moving down. So not only we are waiting for the price to cross our band, we are also waiting for it to cross the zero line as well. That is known as the last, allowing an extended move. That means you're okay and you're open for a very big correction to take place, but you don't want to exit the trend early. So that is for those kind of people. So the basic exit is basically removing your trade whenever the momentum reaches the zero line. That is the benchmark case. It is based on the conservative assumption that the prices will return to the center of the recent movement. So what do you understand by the price reaching to the center? That is the mean reversion, right? It is less reasonable to assume that prices will continue move from overbought to oversold and back again. That's not always the case. The price can also stay for a very long time near the zero line. So in that case, you're just losing out on your time and energy, because if the price is oscillating in the same area for a long period of time, then there is no point of holding that trade, right? You can just exit it and you can put that money somewhere else where there's a trending instrument. Okay, so we have discussed many exit criteria or many exit strategies. The only reason we discuss many are because every person has a different method of trading. Every person has a different kind of risk management and risk appetite. So the exit is always going to be dependent on your personal strategy. How much are you willing to hold? For how much time are you willing to hold? And for how much um, risk horizon? All of that is going to basically decide your particular appetite. The same momentum calculations viewed over a longer time period show one of the problems using the momentum for timing. 7.8, let's look at this. A longer view of 20 and 3-day moving average applied to the S&P. The magnitude of momentum values change over time. Now what is the issue here? Let's see that. From August 2005 to Feb 2011, notice that the scale of the momentum value changes dramatically. So you can see that momentum over here changed dramatically, right? So that is because I'll tell you why that happened. So you all know what happened in 2008, the market crash. And before that, you know that a lot of volatility was in the market in general as well. So a lot of unexpected moves were happening during that period of time because of the banking crisis. So in that situation, what happened was that volatility was low in 2006. But if you would have used momentum as an overbought or oversold indicators, then the entry would have been at about plus minus 30. For the 3-day momentum, it would have been closer to plus minus 15. You can see this, you can see this. Pause and look at the graphs for you to understanding it better. Volatility basically increased in 2007, 1 year before 2008. So what happened in 2007? If the buy entries were targeted as momentum values of minus 30, then the traders would have held a 120 point of momentum loss. See, look at this. If you took a buy trade over here, you would have taken a buy. Then what happened? The price went low, so you would have taken a loss by just following the momentum indicator. So it is not so easy to use just the momentum indicator for your trading. You need to be aware of the other factors as well, and you need to use momentum indicator as a confluence rather than the only thing you're taking a trade with. Okay, so the range of the bands also have to be adjusted according to your accordance. Okay, next we'll talk about what is risk protection. So having a stop loss is always mandatory. You need to keep a stop loss whenever you're trading. That is not negotiable at all. And if you're trading something against the trend, if you're taking a trade which is against the trend, then in that case, you need to for sure keep a very tight stop loss. A stop loss is a specific order to exit if the price goes the wrong way. You know that what a stop loss is. I don't even have to explain it. Since you are already in CMT level 2, then I'm sure you know what a stop loss is. And whenever you are taking conservative entries, even then you need to keep a stop loss. But whenever you're taking aggressive entries, in that case, you need to be 100% sure of keeping a really good stop loss. Because the probability of being stopped out of a trade when you're taking an aggressive entry is more as compared to you being stopped out when you're taking a conservative entry. While the other entry options allow for a logic positioning of a stop loss, the aggressive entry does not. You will simply need to decide based on the historical momentum value where to limit your risk. Now, if I combine momentum with, let's say, a candlestick pattern or any other method of trading, then in that case, I'll have a proper logic where to keep my stop loss. So, whenever you're taking a trade based on momentum indicator, make sure that you're also having another confluence like a candlestick pattern or volumes or whatever, and keep your stop loss according to that and not just according to the momentum. Not just calculating the range of the momentum and keeping a stop loss. That will not work. So, how, even after this, if you want to explore how to keep stop losses along according to the momentum indicator, then that also we are going to see. Place a protective stop above or below the most extreme high or low momentum value. The nearest high or low momentum value, that is where you keep your stop. Follow a profitable move with a trailing non-deteriorating stop based on fixed points or percentage. Keeping a percentage stop, that is, if I go in 2% profit, then my stop loss will become 1% or stuff like that. Establish zones that act as levels of attainments. Now, what does that mean? The way we draw support and resistance like that only, drawing a support on the indicator like this. For example, you can see that the price tap this went down, tap this went down, tap this went down. So if I'm in a short trade, I can keep my stop loss right above this. That is one way of keeping a stop loss. Risk protection must be flexible in the ways it deals with volatility. As the prices reach higher levels, increased volatility will cause momentum tops and bottoms to widen. With low volatility, price might not be active enough to penetrate the upper and the lower bounds. But if the volatility is high in the market, then in that cases there can be really, really violent moves and the price can penetrate the high and the low sooner than you can imagine, and it can also cause you to take your stop losses. So whenever you're keeping a stop loss, you need to take into account that you are considering the volatility which is present in the market. Okay. One more thing you need to know. One should never forget that declining momentum does not mean that the prices are falling. Momentum does not talk about the direction of the price. Momentum is just talking about the strength of the trend. If the price is going up and the momentum is going down, that means that the uptrend is not strong. If the price is going down and the momentum is going up, that means that the downtrend is strong. That doesn't mean that the price is now going to go up. Do you understand what I'm saying? It only talks about the momentum of the trend, be it whatever trend. Whether it is an uptrend or a downtrend, momentum just talks about the strength of the trend. It has nothing to do with the direction of the trend. The trend provides protection. Momentum is not a strategy itself, but it is a way of entering a trend trade. When a trend signal occurs first, it is not entered. If the signal was long, then the strategy waits until the 3-day moving penetrates the lower band. If the price continues lower, then the trend will change from up to down and the position will be exited. It would not be necessary to have a stop loss. This is basically a strategy which is clearly a trend based strategy or a trend following strategy. Profit targets for fading extreme moves. When using a momentum as a mean reversion strategy, the most reasonable exit for a short entered at an extreme momentum high or a high position entered at a low. So when the momentum was very high, which let's say the indicator was overbought, if you sold there, when the indicator was showing overbought, then where do you exit that trade? You are going to exit when the momentum returns to zero. The moment the momentum returns to zero, you need to exit out of your trade. Returning to zero does not mean that all trades will be profitable, but that is a safe way for you to exit. Okay. The number of profitable trades can be increased by targeting a momentum level that is more conservative than zero. So, if you're going to wait for the price to reach till zero, there might be some times when your trades are running in profit, but you're waiting for it to reach zero. So, you might book a loss. So, rather than that, you need to keep a more conservative level, which is higher, which is better than zero level. Trades that almost return to normal would then be closed out with profits, although the average size of the profit would be smaller. So that's why I keep saying that you need to keep booking partials. Okay. High momentum trading. Some professional trades have made a business of trading in the direction of the price move only when the momentum exceeds the high threshold level rather than anticipating a change of direction. Just because the momentum is extremely high, that doesn't mean it reverses. Sometimes, when the trend is so strong and the momentum is so high, the momentum keeps continuing until a long period of time. So, you cannot just assume that just because the momentum is extremely high, now it's going to reverse. That's not how it works. Even if you look at examples, I can show you how that is. Look at this. Look at this. Look at this. If you look at this area from here, the price was already oversold. You can assume that since the indicator is showing oversold, from here the price should have gone up. But what happened? Even after the indicator showed me oversold, the price still went further down for a long period of time, right? For a long period of time, for so many candles, even after it showed oversold. So sometimes momentum can keep going and can keep the strength strong. Don't just assume that just because the momentum is extremely high, now there's going to be a change in the direction. That is not always the case. High momentum trading is a fast game and it requires tools that allow you to scan a wide range of stocks. So whenever you look at if you have if you're trading in stocks, if you have a screener or something, you can screen and you can find out stocks which have really high momentum, and you can look at opportunity. You can look for opportunities in that particular trade. Okay. Now we're going to learn about MACD, which is the indicator, which is moving average convergence divergence. Before we get into the details of the indicator, let me just put it and let me just show that to you. So this is how MACD looks. One sec. MACD. Why is it not coming? MACD. Yeah. So this is how a MACD looks. MACD stands for Moving Average Convergence Divergence. You know what convergence and divergence means in general. Now we are going to learn about this particular indicator. This is also one of the momentum indicators and oscillators. So, like we discussed, there are various problems when it comes to momentum. So, in order to solve the problems which are occurring by using just momentum, people have developed this indicator which is known as MACD. MACD was developed by Gerald Apple. The MACD uses momentum calculated as the difference between two trend lines produced using exponential smoothing. So, two trend lines are used and they are exponentially smoothed. Keep that in mind. Two trend lines are used and exponentially smoothed. So if there's an MCQ which states that what is MACD calculated by, the first thing that should come to your mind is that MACD is calculated by two trend lines and which are exponentially smoothed. The momentum value is further smoothed to give a signal line. So when do you get a signal line? After you get the momentum value by calculating two trend lines and by exponentially smoothing it. After that, when you again smooth it, that's when you get a signal line. Again, let's quickly revise how we get an MACD line. How do you get an MACD signal line? Now I understand that we have so many softwares, we have TradingView, and we have all of these softwares which gives us the indicator. So why are we even supposed to learn the formulas? That's the same way I feel, but then the exam demands that we learn the formulas and it can be tested in the exam. So in that case, we need to learn. Try to learn it in the video itself. The MACD is calculated with two trend lines which are exponentially smoothed, and after that you are again smoothing it, and that will give you the MACD signal line. Now the two trend lines which we are using, that is going to be of two periods. Usually when you're using MACD, people use the values of 12 and 26 day exponential smoothing. 12 and 26 day. Whereas the signal line uses 9-day smoothing. Okay, let's go into the detail. First of all, you're taking two calculation periods, 20 and 40. Then you are going to convert it to smoothing constants using 2 upon n plus 1. For smoothing, you use 2 upon n plus 1. And then you calculate the slow trend line using E40. And then you calculate the fast trend line using E20. Slow trend line is using the 40 period because 40 is a larger time frame, right? So whenever we are doing something or whenever we are using a higher time frame thing, that is going to give you slower signals as compared to the faster or the nearer time period trend line. Okay. So what was the first step when we are calculating the MACD? We are choosing two calculation periods. For example, we are choosing 20 and 40. After you chose two trend lines of two periods, let's say 20 and 40, you are going to convert it into smoothing constraints. That is n, that is 2 upon n plus 1. Again, first thing you're going to do when you're calculating an MACD is you are going to take two calculation periods, which is let's say 20 and 40. And then you are going to smooth it using the formula 2 upon n plus 1. 2 upon n plus 1. After that, you're going to find the slower trend line, which would be the higher time frame, which would be the E40. And then you're going to calculate the faster trend line, which is going to be E20. Then the MACD line is the faster responding line in the bottom panel of 7.9. Let's look at that. Okay. So you can see that this is how an MD looks, and these lines are the signal lines. This, let me just show it you in the trading line. You can see that these lines, these are the signal lines. Here we have used fast length, slow length. That's what we've been discussing. What should be a fast length and what should be the slow length? We just discussed that. So when you're learning these formulas, if you want to remember it for a long period of time, then you need to open TradingView and you need to relate it with this and then try to learn. Okay. So the MACD line, the faster responding line, is the difference between E20 and E40. When the market is moving up quickly, the fast smoothing line will be above the slow and the difference will be positive. That is done so that MACD line goes up when the prices go up. Signal line is the 9-day smoothing. The signal line is slower than the MACD. If you look at this, we have two lines. The lower one is the signal line and the higher one is the MACD line. Which is slower among these two? The signal line is slower. If you look at this also, you can see there are two lines. One is the MACD line and one is the signal line. Again, quickly let's revise the steps. You are going to take two calculation period, let's say 12 and 26 or 20 and 40, and then you're going to smooth it, which is 2 upon n plus 1. Then you're going to calculate the slow trend line and the fast trend line, and then you're going to calculate the MACD trend line, which is the difference between the two, and then you're going to find the signal line, which would be the smoothed momentum value. Usually the signal line is of 9 period. Keep that in mind. Signal line is of 9 period. Okay. So now we have discussed that. Let's see how do I use the MACD indicator. Yeah. This is how it looks. We know how the MACD indicator looks, right? The MACD line is higher in an uptrend and lower in a downtrend. The histogram is created by subtracting the slower signal line from the MACD line. Okay. What is the histogram we are talking about? You can clearly see an histogram over here, right? This green area, this red area, this stuff, that is the histogram. So this histogram basically is giving you the direction of the trend. It tells you where the trend is going to go. If you again look at it, you can see that histogram is created by subtracting the slower signal line from the MACD line. So when you minus MACD, when you minus the signal line from the MACD, you get the histogram. So whenever you remove the signal line from the MACD and you know that signal line is slower as compared to the MACD, so you are going to remove the signal line from the MACD, then you get the histogram. And whenever the histogram is above the level 0, that means it's an uptrend. So here you can see 0 is the middle line, okay? Don't get confused. You can see here the histogram is positive above 0. So in that case, what happens is the price actually went up from here. And the same thing, the red one is when it is below, then that shows a downtrend. You can see that the price actually did go down. Yeah, it did go down corresponding. So that is MACD for you. Okay. Now let's see how do I trade the MACD. The most common use of MACD is as a trend indicator. How do you use the MACD and the signal line for the same? When the MACD line, the faster line, crosses upwards through the signal line, then you are supposed to buy. When the faster line cuts the slower line, you're going to buy. When the signal line cuts the slower line, you're going to buy. When the MACD line, which is the faster line, closes the slower line, you are going to sell. Simple. When the smaller time frame line crosses the bigger time frame, you're going to buy. When the bigger time frame crosses the smaller time frame, you're going to sell. Very, very simple way of using it. Okay. Now, what is divergence? Divergence is basically, let me just quickly explain to you what divergence is. One sec. Yeah. Okay. So if the price is moving like higher highs, higher lows, it's creating higher highs and higher lows. But the momentum is creating lower highs and lower lows. That means the uptrend is going to stop. If the price is creating lower highs and lower lows, and MACD is creating higher highs and higher lows, that means the trend is gonna reverse. Same thing again. So that is what is known as divergence. If there are two opposite things, then you need to be clear of it because that is going to give you a signal as well. That is divergence. A method similar to MACD but one that uses an interesting combination of generalized techniques is the divergence index. The volatility adjusted difference between two moving average. Slow average is 40-day, fast average is 10-day. Differences between price today and the price previous day. Simple. What is divergence index? Fast average minus slow average divided by the standard deviation with a bracket of the difference between the two and the slower period square. You need to by heart this particular formula. How do you find the divergence index? If that's the question, what are you going to write? Fast average minus slow average divided by the standard deviation of the difference difference comma slow period then square. Again, divergence index, fast average minus slow average divided by the standard deviation of the difference multiplied by slow period, bracket close, squared. It's that simple if you actually keep practicing it. The standard deviation of the difference is taken over a slow period and volatility adjusted. So, how do you calculate the band? Standard deviation, divergence index, slow period. Upper band is factor multiplied by band, lower band is factor multiplied by band. Factor is basically the calculation which we get. Factor is usually 1.0. How do you get 1.0? You are basically calculating the standard deviation of the divergence index. Okay. The rules over here works just like RSI, overbought, oversold. You know that? We've discussed that. Okay. I think this video is pretty long and it's a pretty boring chapter. So can't help it. Gotta do what you gotta do. So I'll stop this video over here. In the next video, we'll be completing this chapter. We'll start from oscillators and we'll also revise the entire chapter in a quick recap. Thank you.